Hi, I'm Doug Purcell with Orchid Realty Group. Thanks for watching my channel. Today we're going to be talking about mortgages and the mortgage process and going over different terms that you may or may not be familiar with, and if you're not familiar with them, it'll give you a better understanding of the importance of some of these things that you'll be encountering when you're going through the mortgage process when you're buying a home. Hi, I'm here today with Danielle Damianov, who is the sales manager for CMG Financial, and we're going to talk about mortgages. Danielle, you'd like to explain?
I'm Danielle Damianov. I'm the sales manager here with CMG Financial in Southwest Florida, and I'm excited to talk about mortgages. I know when you're a realtor, it's a very, very important part of the process.
Yes. So, and speaking of process, the very first thing that anybody should do when they're considering purchasing a home and getting a mortgage is they need to be pre-qualified, pre-approved. What is the difference between pre-approval and pre-qualified, and what's the process or the information you would need from somebody in order to give them a pre-approval letter?
Yeah, I get this question a lot, and the difference between a pre-qualification and a pre-approval, there's a big difference. And especially in this market, you want to make sure you're pre-approved and not just pre-qualified. What happens with a pre-qualification is, as a loan officer, you'll take the loan application, you'll pull their credit, and then you'll get a verbal from the client as to what their income is, how much they make, how much they have in assets, and things like that. Once you have that information, that's a pre-qualification where we're taking the client's word as to what they have for assets, income, and things like that, and doing a pre-qualification based off of that. A pre-approval, which is what I do, is I take it a step further. And I know in this market, everyone is so busy. So a lot of times I'll hear that other people are only doing pre-qualifications because that client may or may not buy. But the last thing you want to do as a real estate agent is go out with a client that's not pre-approved. And the reason why is because a pre-approval is that second step in the process. That's when we're going to get their income documents and actually look at their W-2s and pay stubs and tax returns. We're going to get the assets and actually look at their assets to see how much money they have in the bank. We'll obviously look at the credit again, and everything that goes into that loan process. And then we'll run automated underwriting, which is going to give us that pre-approval and let us know if they really are qualified based on whatever loan program we're going through. So the first step is that pre-qualification process. Some people stop there, but you really need to take it a step further because pre-approval is where we can see exactly what they qualify for and what they don't qualify for. And I know in this market, especially when you're making offers on listings, those listing agents want to see a pre-approval. They don't want to just see a pre-qualification.
So let's say someone has all of their bank statements, their W-2s and so forth, and they give that all to you. How long does it take to actually generate a pre-approval letter?
I can do it same day. It just depends on how many applications and pre-approvals we're working on. Typically it takes the client a day or two to get us exactly what we need, and then another day or so for us to review everything and give that pre-approval letter.
And then because you're also reviewing their debts, their debt to income, which that's going to give the buyer a price that they can shop for on a house, how much they can afford.
Exactly. And so it's funny because a lot of times people will come to me and say, well, I only want to look up to $200,000. But then once I get all of their documentation, they realize they can actually go higher than what they were thinking, or vice versa.
Right.
So yes, debt to income, the four main things that we look for in an application is number one, credit. So we're looking at the credit score. We're also looking to see if there was any major events such as bankruptcies or foreclosures or short sales. We're looking at their debt to income ratio. So that's another huge key component in getting approved, is what their debt to income ratio is. We're looking at their assets, how much do they have to put down, and then we're also looking to see if they're moving money around, if there's any large deposits and things like that. So credit, income, asset, and debt ratio, those are the 4 components that we look at in the loan, the 4 major components.
Right. So, of course, credit's going to be important because that's also going to dictate the interest rate that they may qualify for. But let's say they have a few debts and based on their income, is there a certain percentage that they are allowed to have that will determine what amount they can afford for a mortgage payment?
Yes, so if you're going with a conventional loan, typically you have to stay, and there's a couple little different things, but for the most part, rule of thumb is you have to stay under a 50% debt ratio, so 49% or lower for conventional. For FHA and VA, typically we can go to a 56% debt ratio. And what we're looking at for a debt ratio is we're adding up all of the monthly payments on their credit report, not their balances, but how much they pay monthly.
Right.
And then we're adding that new proposed housing payment. So whatever that new proposed housing payment is going to be, and that total figure divided by their monthly income is how we come up with the debt to income ratio.
Okay. And if they, let's say they have no debts, is there a certain percentage, or say they have very few debts, is there a certain percentage that can be allocated toward a mortgage payment, or is it just whatever it is?
It's
as long as it's under 50%.
Yeah, as long as it's under 50. However, a lot of times when we're running our automated underwriting, it doesn't really like when you have 50% of your income going towards your mortgage.
Right, because people are going to spend money.
So,
Okay.
right.
Right, okay, well that makes sense.
Yeah.
So let's talk about the different loan programs. You know, everybody has heard about conventional mortgages and FHA and VA. What are some of the bigger, or the differences, and how that might affect what someone's willing to being able to buy?
Okay, so we all know conventional FHA, VA for the most part, and you've heard of Fannie Mae and Freddie Mac, which is typically your conventional mortgage. The conventional mortgage is basically going to be for anybody that has decent or great credit, has some money to put down, and has that debt ratio under 50%. That's really what we're looking for. If somebody has a lower credit score, we can go all the way down to a 580 credit score on FHA. On conventional, we can go all the way down to a 620. However, you're going to get better pricing on conventional when it comes to interest rates if you're at that 660 or above. FHA, we have the higher debt to income ratios. We also have lower years of seasoning for foreclosures and short sales. So if you're going conventional and you had a bankruptcy, let's just say a Chapter 7 bankruptcy, you have to wait 4 years before you can get a conventional loan. Where on an FHA loan, it's only 2. So the difference is FHA does have or allow for some credit, like short sales, foreclosures, bankruptcies that have happened recently, where conventional requires a little bit longer. And then the difference also is FHA is going to have loan limits. And every county has their own loan limit. And what that means is you cannot borrow anything higher than the loan limit for that particular county. So for Lee County, it's $336,000. For Collier County, it's $450,000. Meaning that's the maximum you can borrow.
And does that generally change every year?
Yes.
Okay.
Yep, every year, and it has been trending upwards.
Right. So, you know, a lot of people think that in order to get a conventional mortgage, they have to put 20% down. That's not necessarily the case. However, when you do put less money down, you do have to have private mortgage insurance.
Exactly.
And private mortgage insurance is going to fall off on a conventional mortgage once you have 20% equity in the home, correct?
Yes.
Does that the same for a FHA or a VA?
So for VA, one of the benefits of VA is it's 100% financing and there's no monthly mortgage insurance. So if you're a veteran, a VA loan is the way to go if you're not wanting to put any money down. So you have great pricing on VA loans. We can go down to a 580 credit score. There's no monthly mortgage insurance and you can get 100% financing. And if the seller pays for the closing costs, you can essentially get into a loan with almost nothing out of pocket on a VA. So for conventional, yes, if you put down less than 20%, you do have that monthly mortgage insurance. The mortgage insurance, the amount of the mortgage insurance is going to depend on the credit score and the loan to value and basically the whole loan profile. In some instances, it might only be $40, $50 a month, which is not that much, but it will allow you to put down 5-10% as opposed to 20. For a conventional loan, we can go all the way for a first-time home buyer to 3% down payment. So if you're a first-time home buyer, you only have to put down 3% on a conventional. If you're not a first-time home buyer, then you have to put down 5%, second home is 10%, and then investment property is 15%, depending on if it's single-family home or condo or duplex.
Okay, now what's a jumbo loan? Because
So-
we hear jumbo occasionally.
Yes, and in this market, there's a lot of jumbo. Especially in some of the areas that you're selling in, anything over 548, 250 is considered a jumbo loan. So we have a lot of jumbo products. Our jumbo products are very, very strong. We can go all the way up to 5 million. There are a lot more restrictions on a jumbo loan. So you need to at least have a 700 credit score. We have one program we can go to a 680, but 700 is kind of where you're wanting to be on a jumbo.
Well, Danielle, thanks a lot. We covered a lot of information. And, if you ever have any additional questions or you needed clarification about any of the items, feel free to drop a link below and we'll be sure to get back to you just as soon as possible. So,
Subscribe to his channel.
yeah, right. So, Danielle, thanks a lot again.
You're welcome. Thank you for having me.
All right.